how do we know that our product is financially viable? Well, we have some tools for that. And one such tool is the break-even analysis. So we have here a simple graphic that shows where it's profitable or it's not profitable. We have our break-even quantity. So along the bottom here, we have our quantity in units. On the left-hand side, we have our dollars. So if we have our line here that shows total revenue, it goes from 0 all the way up as we build and create more units. Well, our break-even point is where our total costs equal our total revenue. And anything after that that we create should be adding to profits. So we have to factor in fixed costs, our variable costs, and our price per unit. Once we factor those, we can know that we have broken even, or at least how many units it will take to break even, the quantity. So, what is the formula? So here's the formula. So we have Q sub BE equals fixed costs over our price per unit that we sell it for, our sales price per unit, minus our variable cost per unit. That's simple. So fixed costs, what are fixed costs? So our fixed costs are like our overhead, our insurance costs, stuff like that. Our variable costs, those are costs associated with making each unit, including direct labor and materials. So we have to know that information first. So let's do a quick example here. So in this example, imagine you want to start up a company to manufacture and sell sporty polarized sunglasses designed in university colors and featuring university logos. You've done your homework and estimate the variable costs, including trademark privileges. You can't just use somebody's trademark without getting a license. So that cost, the variable cost for that, will be $57 a pair. And the fixed costs will be $78,000. If you sell the sunglasses for $99 a pair, how many pairs do you need to sell to break even? Also, if you can sell 5,000 pairs to current students and alumni of your alma mater, how much money will you make? So we have two questions here. So first, let's figure out our break even. As you can see on the screen here, our fixed costs, as it said in our example, is $78,000. And our sales price per unit is $99 a pair. But the cost to make that unit is $57. So we have $78,000 over 99 minus 57. So that's going to give us a number of 1,857 pairs. So that's the answer to the first one. So what is our profit, right? So we have here a quick formula for profit. So profit equals our sales price per unit times the quantity minus our fixed costs. And we have to add our variable costs, and we multiply our variable costs by the quantity. So that's going to equal, in this example, $99 times 5,000, and then we're going to subtract the 78,000. We're going to also add $57 times the 5,000. Once that's all said and done, that's $132,000. So we've made, if we produce 5,000 pairs of sunglasses, $132,000 in this example. Not bad, but this is assuming we sell 5,000 pairs. Just to break even, we need to sell 1,857. So first we need to evaluate, can we sell 1,857? If we can't even do that, we're not even going to make any money. So we want to be able to ask ourselves, can we make 1,858 pairs? Because then we have the profit factored in, right? So we'd have a little bit of profit there. And of course, we're in it for profit in a company like this because we can use that profit to maybe make another product. So that's the break-even analysis. The next tool that we have to determine financial viability is the net present value. Well, we're going to take a look at our initial outlay. How much money did it cost to get this started? Well, what did it cost to develop and launch the product? So in that last example, before even producing anything, it cost $78,000 in our last example. Because those were fixed costs. That might be the cost of the building mortgage or paying for building, buying equipment. Those are fixed costs. We had to pay those. But then we have our annual costs, our revenue here. How many units of the product will we sell? The last one we figured out how many we had to make to break even, and what would we make if we created 5,000. So the next one here we have, what will it cost to promote and sell each product? So how much are we spending to sell a product? Are we going to spend $5,000 for marketing? Are we going to buy ads on the internet? Are we going to pay for a commercial for TV, radio? Might be difficult to sell sunglasses on the radio, but it's possible. So what will it cost to produce and deliver each product? You have to think, how is it getting to your customer? So producing it, our last example said $57. But what about the delivery? How is it getting to that customer? Are we going to have to pay for shipping to get it to the customer? Or are we going to charge the customer for that shipping? And how much are we going to generate from each sale? Are we expecting $50? Are we expecting $10? What is the math showing us? And then we have our end-of-life cost, our revenues. So what will the product's end-of-life cost or disposal look like? Well, in our last example, it was a pair of sunglasses, right? What is the cost of disposal for that? Well, odds are probably going to lose the sunglasses. I've lost my fair share of sunglasses. So disposal cost for me was nothing. But you could throw them out, you can donate them, you can do whatever you want. Probably there is no cost for sunglasses. But in some things, it actually costs money. So think of a piece of equipment. It's going to cost some money. Think of your car. Some places you have to pay, let's say a hazmat fee, a hazardous materials fee, to put your car in a junkyard. So depends on where you live. So let's take a look at sunglasses. All right, imagine your upfront design and launch costs are $90,000. So we have an increase here. And you expect to sell 2,500 pairs of sunglasses the first year and 5,000 pairs each year for the following 4 years. Your sales price will be $99. And your cost per unit, including overhead, that's including your fixed costs, will be $88. At the end of 5 years, you hope to be able to sell Wildcat sunglasses for $100,000. So you're looking to sell your company for $100,000. If your required return, also known as your discount or hurdle rate, is 15%, what is your net present value, your NPV? So let's look at it. So your initial outlay, your design and launch costs, is $90,000. So we have our annual costs and revenues. So our first year, we're expecting to sell $2,500, and we're going to multiply that by our sale price minus what it costs to make. 99 minus 88, right? So 2,500 times $11 essentially. So that's going to be $27,500. Then years 2 through 5, it's 5,000 units. You're going to do the same thing. 5,000 times your sale price minus the cost to make it, which in this case is still $11. So we have $55,000 for years 2 through 5. And then your end of life cash flows. So when you sell off your company for $100,000, so we have $100,000, or $120,173 is your net present value. So you might need to use your calculator or Excel to calculate the net present value on this one. But it's not that difficult. So your net present value is the sum of the present value of all cash flows minus your initial outlay. So your net present value, so we have all of these minus this. But we haven't gotten to all these yet, right? So it depends on where we are in here to figure out what our net present value is. Right? So we have to know where we are in this 5-year plan. And once you know that, it should be easy to figure this out. Now, you can ask your accountant to do this. And your accountants can do this if you have a company. So I wouldn't get too hung up on how to figure out net present value. It's not going to be a question I'm going to put on all your quizzes or it's not your quizzes, your exam. I'm not going to put this question on your exam. I'm going to actually remove it. But just so you know, your net present value, in this case, looks like 15% is, yeah. So you have a discount rate or hurdle rate is 15%. So just so you understand, you have your discount or hurdle rate is 15%. So you're taking 15% of everything right here. Let's see. Let me get to the right indicator here. Alright, so we have our 15% right here. But we're taking 15% of all of this. And then we're subtracting the 90,000. And that's how you figure out your net present value. Not difficult, but imagine if your numbers were a lot more complicated. So leave it to your finance people when it comes to this, and you should be fine. But definitely know the break-even analysis. That one is essential, because that's going to come up more often than you think. Alright, so we're going to talk about target costing next. And target costing is something we definitely do in supply chain. And you'll find out why in our next video.